The following is a presentation of TFNN. Trade what you see with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. Hope everybody had a wonderful weekend. We had a good time at the Money Show. I'm going to start the show today because this is a big day historically in the market. Just like October 29th, 1929 was. We had a crash October the 19th, 25 years ago in 1987. I remember that sequence of that days very, very much. On the 18th of October, which was a Sunday, of course, followed by Monday. Well, you have to be pretty good at doing that, don't you? Anyway, I was in Los Angeles, actually in Beverly Hills, at the Bel Air Country Club. One of my good friends was getting married. It was a very big wedding, and a lot of friends from Drexel were there, and a lot of other people, of course. But I took my daughter, Jill, to the wedding because she had some friends that she had made at Drexel through the years, kids of other brokers and customers too. So it was really a really nice time, and it was just really a wonderful event. When we came back, it was an all-day event, and when we started leaving Los Angeles around 6, I dropped Jill off at her place at around 9, and I went over to the office up in Pismo Beach, and I for some reason, I called the overnight desk. I don't know why. Maybe the Dow had closed down 106 points at about 20, I think it was around 2,500 and something, as I recall. Let me see, 500. I don't remember. No, it was around 2,100, I think. Yeah, 2,100, because right around 2,000, as I recall, because the next day it was down to 1,664, so it had to be in that area. And they told me that the Swiss franc, which I was long, was up about 150 pips, and gold was up $25, and I had some long gold. I had some short S&P, but they don't trade overnight, as you know. And I asked what was happening with the Nikkei. It was trading at around 30,000 on its way to a new high at on December the 29th of 1989 when it hit 39,000. I think it was around 32,000 then, and it was down about 900 points. Nothing really big on a number that high. So I was, a little concerned about, the Swiss franc and the gold, what the news was. And the broker at the desk said, well, he said he thought it was something to do with Secretary Baker saying something about a, trade agreement of some kind. So when I came back in the morning around 5, we started getting our first indication that something was wrong when the brokerage company, I was going through using CQG at the time, and they alerted everyone that they would not be responsible for open orders in the options pit, the CBOE. And that's what happened. Anyway, when the market opened, we were trading at that time. We were trading. We trade a $50 handle now. In other words, 1 point in the S&P is worth $50. Well, at that time, this is when we had the big S&P. It was trading at 10 times that. So one S&P contract moving, 1 point was $500, not $50. So you could imagine, the leverage that we had at that time. But remember, the S&P was trading at it closed at around 280, I believe. It was around 280 that it traded at on Friday, as I recall. And I'm just doing this from memory. And the Dow opened down 300, and of course it had never done that before, and that literally that just scared the bejeebies out of everybody. And then, as you know, that day the market just kept going lower and lower. It just kept dropping. There were no fail-safes. They didn't stop for limit orders. There wasn't a protection team or anything like that. It just kept going down and down and down. And it finally, closed down 16.5%, down 555 points, as I recall, that day. The next day, the market opened slightly lower, and that low was an exact 61% retracement to the third decimal point from the low of August the 9th of 1982. And from that level, the market went all the way up to 18,000 and change. What turned the market, folks, was a meeting of the Federal Reserve and the Treasury Department, Rubin and Greenspan, who are both best friends. And basically what they did is they allowed the banks to mark their inventories to the market. In other words, if they owned JP Morgan at 42 and the stock was at 27, they could mark it on their books as 27, not 42, showing a $15 loss. I asked the brokerage firm if we could do something like that, and of course they laughed at us. But this is what turned the market. It allowed them liquidity to step in and start to buy, and that's pretty much what it is. History says, from other interviews and some of the writings that I've heard, is basically Greenspan picked up the phone and he called Goldman Sachs first, then he called JP Morgan, then he called Lehman Brothers, then he called Morgan Stanley, and he said, it stops going down here. The Fed window is open. Take as much money as you need and buy whatever stock you need or you want, because it's not going any lower today. That's what he said on the 20th of October. Now, that's a lot of power. And it was a cycle low. I mean, that's basically it. You know, it happened to be a major cycle low. It happened to be the best buying opportunity of the 1980s. And other than 1982, of course, when the Dow was down around 650 or 700. So we'll see what's acting, you know, see how it's acting. So anyway, that's what happened. And the liquidity was something that scared everyone. Anybody that was a trader of any experience at all was scared to death that day, because the bid offers on the S&P at $500 a point would be a 230 bid and a 245 offer, 1,500 points or $7,500 between a buy and a sell. There were no brokers in the pit. There were a few order fillers in the pit, but there was no one out there trying to scalp or do anything like that. The pit was absolutely empty. There was just nothing going on other than, you know, continued selling. And there was a lot of that. But the regular brokers, knowing the fact that if they got in an out trade where someone didn't recognize the trade that they did, they could go, you know, bankrupt. And there were a lot of bankruptcies on the floor that day. But you know, that's what happens, because it's a risky business sometimes. But that's what happened. It was just very, very poor liquidity. On Tuesday, the 20th, the market bottomed and held together for about a week or two, just chopping around. And then another couple of months, it chopped around. And I think it was about 6 or 7 months later, we finally took out the high that we had made back on August the 25th at 25.75 in the Dow. And we continued to go higher into the area of 18,100, which I think is so far the high that we have, you know, in place as of May the 19th. So that's what happened. Now, what's interesting is that figure that we had of 2,555 or 60, whichever the high was on August the 25th of 1987. By the way, on that day, that was known as harmonic convergence, because we had 5 planets that were actually at conjunction 0 degree, and all of them were in Leo. I mean, that just almost never happens. And that was the end of that bull market for well over a year and a half. What was interesting is in 1991, when we had the Iran-Iraq war, or the Desert Storm War, when the market was down quite a bit, it came almost to that level again. It'd been up around, I forget the level it was at. It was 4,500 or something, backed off into nearly that exact same high. And then, of course, the next day after the Desert Storm was a one-day war, you know, the market had one of its biggest up days on a percent basis that it's ever had. I believe the market was up about 5 or 6% that day. I just know it was big, because that was another important time in my life when I remember, you know, when things were really happening. But October of 1989, we don't want anybody, you know, really want to, you know, really go through that again. It's not a very, very fun thing to do, no matter what you look at. Now, I want to go over a few charts here. because there are some real critical levels. Those of you that like the Gartley pattern and the ABCD pattern, you're going to take a look here at the New York Stock Exchange Index, because on Friday we had a perfect ABCD pattern. That ABCD moved measures to 10,422. The high on the NASDAQ, on the New York Stock Exchange Index on Friday, was 10,422. That's a perfect ABCD correction. Gartley said in his book, Profits in the Stock Market from 1937, that the best trade that you can have is trading with a trend, of course. And if you look for an ABCD pattern in a downtrend, that's really a good opportunity. And this is what we have going on with the New York Stock Exchange Index as we look at right now. It's just a tiny bit above the 50% retracement level, and it finally took out the February, let's try it again, the September 17th highs. If you remember, we took it out on October the 12th, and then, the 11th, and then backed off a little bit, and then we took it out again on Friday. So it still has legs, and if we get anything above, that high if we had Friday, then this market's probably going to go a lot higher. That's the bottom line. There's just a lot of numbers that are jumping out at us as we look at these today. If we take a look at the Dow Jones Industrial Average, what it did Friday, it also made a perfect 61% retracement of the move from May the 19th all the way into August 24th. The exact 61% retracement is 17,217. The Dow printed a high tick on Friday of 17,220. Right now we're off a very small amount, I think 40 or 50 points, which is really nothing. But this could be, something very, very important. The only way we're going to know that is if the market turns around and starts moving to the downside. That will tell us that this cycle is moving. I know if we get below, somewhere below 17,500, that would be the that's 17,500. That would be the first indication that there's certainly something that is not right. But it's still very, very early, and anything can happen, and it usually does. I have to tell you a really funny story. That's a warm story, if you like warm stories. Mark Douglas was a big fan of Michigan State football, and they were playing Michigan. In the last second of the game, there was an absolute unbelievable error by Michigan where the guy fumbled the ball, kicked it right into the hands of the Michigan State player, and he ran into the end zone as time had already run out, and scored the winning touchdown. And I looked up into the sky and I said, "Oh, well, I know you're at this game, partner," and I'm sure that's where Mark was that day, because he would really be jumping up and down. It would take a little break here. 877-927-6648.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now, toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and those of you that use Google and search around for things to read, try to read Art Cashin's report today about what happened in 1987. He was with Payne Weber. At the time, I was at Payne Weber years ago. I met him then. That was, 35 or 4, no, more than that, 40-some years ago. Wow, more than that. God, we were both kids because we're the same age. But I'd known him quite a while. He's a really nice guy, but he goes through his explanation. His memories are just like mine. And anyway, it was interesting to go through that. I hope we never have to go through that because it's not a fun thing to happen. Now, what I've done is I've posted into the Tiger TV today the long-term monthly chart of the New York Stock Exchange Index. It shows the massive 3 drive to a top pattern, also known as the reverse point wave, because you have a symmetrical triangle where you have a 1, 2, 3, 4, 5 structure, with 5 coming in here on May the 19th of 2015. And then we broke down below the previous year's lows. That's only the 3rd time we've done that in the last 15 years. Each time that that's occurred, if you'll take a look at the red arrows on the first 2 instances, the market rallied back to a 78% retracement back in 01. That was part of the dot-com bubble, as you'll recall. And then the second red arrow was in the summer of 2008, early summer. I think it was around June when the market topped, and that led to the financial collapse where we lost Bear Stearns and Lehman Brothers and a whole bunch of other companies. And then that's when the too big to fail came in, and then we've had quantitative easing, and we've gone and made new highs up here at this level of where we are right now. But the important thing is that we bottomed on August the 24th, and as of Friday, the Dow Jones, excuse me, folks, the New York Stock Exchange Index has made a perfect AB equals CD pattern at 10,422. If we get much above that today by more than just a few points, that's going to tell us that this pattern is wrong. We're probably going to go a little bit higher. I don't believe we're going to take out the highs that we made on the Dow at 18,000 and change and 2132 in the S&P, but you know, I could be wrong on that also, because quantitative easing certainly has thrown a wrench into normal economic thought because it's a giant experiment. Personally, I think it's going to end badly, but you know, that's neither here nor there. That's just my opinion, and we know everybody has an opinion. Okay. So that's what we're watching here on the long-term chart with the New York Stock Exchange Index over the last 15 years. I want to take a moment to go back over the same type of pattern with the Dow Jones Utilities, and you'll see that they topped in 2014 very early. You'll notice that that is also a 3-drive to a top pattern in the Dow Jones Utilities, but it is not a reverse point wave, because in order for it to be a reverse point wave, the C point, which came in 2009, should have been lower than the one in 2002, and that was not the case with the Dow Jones Utilities. The industrials certainly did, but we did not do that with the Dow Jones Utilities. The other important thing to remember, folks, is in 2009, on March the 5th, when we were making that bottom, when the Dow hit 6440 that day, that was a perfect 61% retracement of the low that the Dow had made back in 1987 in the crash at 16,668, I believe, is what the low was. It was 1,600 and change. I remember that. So after the market rallied up, that low that it made was a spot-on 61% retracement. There was also a ratio off of the low from 1982, the August 9th, 1982 low. So all those numbers were right in the wheelhouse of a perfect, you know, Fibonacci retracement of these things. Now, I spend a lot of time looking at these numbers, and I know a lot of you folks do, and you know, we see some really good setups sometimes, and sometimes they work and sometimes they don't. That's the nature of speculation. But the one I wanted to go over now is the gold market, because we talked about gold. We were very bullish that gold when it was down around the 1080 level, 1090. We got up to 1192 on Thursday. That was a 61%, excuse me, a 78% retracement of the high we made back in May. It was a 50% retracement of the high we made back in January, and it was a perfect AB equals CD pattern. I mean, it just couldn't have been any more perfect. It measured to 1191 and change, and it went to 1192.10. You can't get any, you know, closer than that. Now, I've posted in there the last. We're going to take a little break here, and we'll be right back after these. Boy, this is going fast today. We'll be right back after these few words from our sponsors.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization execution capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
TFNN has just announced a brand new morning lineup that is geared specifically for traders in this volatile traders market. Every morning at 8 a.m., John Logan starts things off with his daily program, The Global Market Pulse. At 9 a.m., Larry Pesavento trades the market during the market open Monday through Friday on Trade What You See. At 10 a.m., Tom O'Brien hosts the Money Masters for the hour, and Basil Chapman hosts his Tiger Technicians Hour at 11 a.m. From 8 a.m. till noon every market day, these traders are with you as they provide up-to-the-second market information so that you can make the most educated and profitable trades possible. The new TFNN morning lineup is happening right now. Tune in to see for yourself what kind of actionable trading discussion they have each morning, Monday through Friday, starting at 8 a.m., live only on Tiger TV at TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and one of the things that I wanted to go over with you is the fact of where we are in the gold market right now. If you'll notice those ratios of rallies, the dollar amounts, in January of last year, we rallied $170 off of the bottom. The next rally was less by 70. It was $70 a rally, and then also in July we rallied 70. We backed off, then we rallied another 70, which made the total rally 120. And if you'll take those numbers, 70, 70, 120, and 70, 170, and get your calculator out and notice that all these relationships were perfect Fibonacci retracements of the 618 or 1.618 variety. Folks, you can't make that stuff up. I mean, that really tells you that there's some type of a pattern in these markets that if you'll spend a little time, looking for it, it might be helpful, to look at it. So what this means is that this top we made in gold at 1192 and the top in silver at 1620 should have really strong resistance. On the second part of that coin is if we get above that, that means there's no more resistance, and this thing is really could go, and it could easily do that. That's why you have to be extremely careful if you're short here, but watch to see, what happens over these next few days. Now, gold has a harmonic number, another number that it repeats over and over again in gold, which is $34 an ounce. If you go back and look at your half-hour charts, you'll see $34 and $17 an ounce pop up quite a bit. So if you subtract 34 from the 1191, that's going to take you down to $1,157 an ounce for gold. And if we hit that and hold well, that'll be a good idea of what you're looking for. That would be a 382 retracement off of the September 14th low when we had that big super full moon down there that was a pretty strong bottom in the stock market. So that's what we're keeping an eye on in the gold. The silver looks very similar, but it's a little bit weaker. We did not make the 61% retracement in the silver. It should have got to 1629 to 1630. We only got to 1620, and we backed off just a very small amount. As a matter of fact, the low last night in silver was exactly I think it came in at 1581 or something like that, was exactly 61% retracement of the previous low that we made back at 1560. So it's still following the numbers, very, very dramatically, in my opinion. So we're at a real critical level here in gold and silver, because if we break out, we're going to go a long way, in my opinion. And when we back off, we want to see what that back off level would be, because it'll give us a good chance to come in and be able to buy it. Now, last night, something else happened that would seem to be of some interest, and that is that the price of the NASDAQ finally exceeded the high that we made on September the 17th. That high was at 44.41 last night around midnight. It's around 2 in the morning, New York time. The NASDAQ got up to, I know it was a little later, it was about 5 in the morning, New York time. The market for the NASDAQ got up to 44.44, and then it didn't go anywhere. It just stayed there for about a half an hour and then started to sell off, and it sold off another 25 points. But 25 points in the NASDAQ is really not much, folks, because that's basically, they're looking at 10 stocks that are, the big stocks, the Googles, the Apples, those are the ones that they're focusing on. Facebook happens to be in that group. So it doesn't take much for the market to move a lot. So, but it did hit that number, and that was also taking out the February high. And you remember, when these things take out those old highs, much like we did in the euro last week, at the we were looking at the euro at 115, it got to 114.92, and then of course it's sold off almost 200 pips, into that low that we had on Friday. We've gone a little bit lower today, and the euro certainly looks like it wants to go lower if we have any type of a rally or not. Now, the one caveat that we have to remember is if we're looking at this high that we had on February the 17th, and we're looking at the ABCD structure in the S&P, that measures all the way up to 2040 in the futures for the S&P. Now, remember, the New York Stock Exchange Index made that ABCD pattern perfectly at 10,422. So that's telling us that this market, the overall broad market, is following along with Gartley's principle of selling the ABCD into a bear market. I don't have any cycle work at all that really is in fact, there's nothing that I can see. The big date for me was August the 8th, and again, slightly on the 12th, which was a very small one. It shattered all of those, so you're just basically looking at patterns when you're watching this. However, someone did share me an interesting study that they had done showing that what has happened at options expiration since February, and it's really amazing. You'll notice that it's happened 8 times, and every time after options expiration, the market has sold off. Well, here we're coming into a market that's very overbought. into options expiration, which was October the 16th, and we got the market down just a small amount, but maybe this is the start of another move. All we know is that if it gets really strong from here and takes out those highs of yesterday in the Dow and the New York Stock Exchange Index, that this is totally wrong, because these numbers they're very, very powerful, and you don't want to stand in front of a freight train if you're wrong. So we're right at those numbers, 17,217 in the Dow, 10,420 in the 21 in the New York Stock Exchange Index. Those are the things that I'm looking at. And the Dow, it's only 30 stocks, but they're price weighted, and that's what everybody follows. I mean, it's the wrong thing to follow, but the New York Stock Exchange Index does not have that big a following, except for the mutual funds, that mark their profit or mark their markets for the stocks that they're holding at those times. So one of the charts that I posted into the Tiger TV to start out the show was this chart of McDonald's. As you can see, it's completing that 1, 2, 3, 4, 5 expanding triangle. That's one of the ones that looks really, really interesting, and it's one of the more higher price stocks in the Dow. So it looks like we're making some type of a significant top here in Nike with this butterfly top and the expansion of 1.618. That tells us that we should be very, very close to something extremely significant, I would think. At that point, we'll have to let the trading gods tell us if that's going to be right or not, but the pattern is certainly there, and we want to be watching that. Now, we did have few divergences that we need to go over. I think they were important. The Dow Jones Transportation was really strong early on Thursday, and then Friday it gave it all back and made newer lows on the week. That is not a good sign, especially when you're in a downtrend like this one happens to be. The Dow Jones Utilities went up and made a 786 retracement of the whole move, which is pretty good. Now, if we look at the IBB, the biotech index, you'll notice that it is just barely at a 382 retracement of the whole move down. For 2 weeks, this thing has gone nowhere. And with the market really strong like it is, this tells you that the leadership that was there is not there. When you get that rotation in leadership, historically, that has not been a very good thing, because the IBB was one of the bigger movers of the stock market on the way up. It was the thing that led it all the way, and as we had the same thing happening in the banking index too. If we take a look at the banking index, you'll see that we had the same situation where we've got the market taking out the August lows just like we did in the IBB, and then it's rallied back to a 61% retracement as of last week. Neither of these indices came anywhere close to taking out the highs of February 17th. So that's telling you that the market is certainly rotating. That's really what it's doing. So those are the ones that you want to, if these start to pick up and get strong, this could be the thing that makes the market, move, a lot better. If we look at the small cap index, we'll take a look at that, and you'll see that we also have made a 78% retracement of the high of February the 17th. Let's try that again, September the 17th. We took out the lows of August, which we certainly did that, and then we rallied back. So you're starting to see some significant rotation in the things that used to be leading the market, and certainly they're not. The first question I have is, how do these markets respond to news? The actual question was, how can a report come out that is so bearish and the market rallies? Folks, that happens all the time. You have to get used to that. A perfect example of that was Thursday. Goldman Sachs had some type of news announcement, because we were on the floor of the Money Show at that time. I had just finished giving my first speech, and we were watching the chart of Goldman Sachs. It opened, I believe, $5 lower, exactly at a 61% retracement, and a perfect Gartley on the 30-minute charts over the past 2 weeks pattern. And it stopped right there, and it rallied $10 $10 a share in that on that day. It didn't go any higher the next day, but for that day it rallied $10 $10 a share, and that was in the midst of major bear news. And I don't have any explanation for it. I just know that it happens all the time. Part of it could be that once the market starts higher and the shorts that are in that, it keeps running and running, they start to cover. And that's a self-fulfilling feeding prophecy, and they just keep buying it and buying it and buying it. Since we're on that subject, I wanted to mention, I'm sure all of you remember this because it was a pretty profound event. On Thursday, with 1 hour to go in the trading, the S&P 500 was still below the lows of September the 17th by quite a bit. It was trading at around 1190. It was making a perfect 61% retracement Gartley pattern of the previous 3 days' lows that were down around 1965, I believe, 1975, sorry. And from that, it was a perfect Gartley, and I was standing next to Tom O'Brien, and we were looking at the chart, and I said, Tom, this market wants to rally on the close. And not only did it rally, the Dow was down 50 and ended up being up 250. So in a matter of 1 hour, the S&P ran 30 points, and the Dow ran almost 300 points. And a lot of that, it was not a lot of volume, because what happens once it starts up, the buyers are bidding, they're raising their bids, and the sellers are raising their offers. So there doesn't have to be a lot of volume in there, and the market just keeps going and going, and that's what happens. And the same thing happened on Friday. The market was down about, I think, about 60 Dow points with about an hour to go. Expect exactly 1 hour to go, and the market turned around and closed, up 60 on the day, right at the Fibonacci number of the whole move from May down into August. So that's what we're watching on some of these indices here. Boy, the day goes really quick here when you're having fun. Not too many questions today, so we'll see what's going on. Okay. The question about prices going up and down. Folks, if you really have a question about whether the market is random or chaotic, you've got to get Andrew Lowe's book, the Non-Random Walk Down Wall Street. But it is not an easy read. If you're not into heavy mathematics, you certainly don't want to buy that book, because it has some of the most intense formulas that you've ever seen from calculus and some other advanced, mathematics far beyond this old cowboy's pay grade. So that's about it. We've had a question about crude oil, and I think oil still has a chance to have a pretty good rally here. That was one of the things that we were watching on Friday. We did hold that 786 retracement in crude, and now we should be looking for it to get up somewhere in that 48 level. I don't know where it's trading right now, but it's not doing very much. It's going down, as a matter of fact. So we'll see if that's going to be the case or not. We'll have to let and see what happens. But right now, oil needs to hold that support at the level of 45. Because if we go below that 786 retracement in the oil, then you're looking at something, something a whole lot different. So I don't know. Hold on one second. Okay, I had to correct something here, get my chart right. All right. Anyway, this is what it looks like to me. As long as we can hold this 46 level in the crude, which is a 61% retracement back. We tested it last night, had a little bit of a rally, and so we've tested it twice now at $46 a barrel in crude. Below that, then you could be looking at much lower. If we get below 45, folks, we could easily see 40 or 35 without any trouble at all in the oil, if in fact it does that. So we'll have to wait and see. Okay, we'll be right back after a few words of wisdom from our sponsors, and we'll wrap up the show.
Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Directions Daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Catch the Money Masters as they teach you the art of mastering money when it comes to trading and investing. Next on TFNN.
Okay, we're back, folks, and we are going to finish the show with the stock chart of the New York Stock Exchange Index, because I believe it's the most important stock chart that we have this week. On Friday, we made a perfect AB equals CD pattern at 10,422. The market closed at 10,421. The high was 10,424. It's a little bit lower today. If we get stronger today, this means this ABCD pattern is most probably not going to work. Much like what happened with Goldman Sachs on Thursday with the market bearish. It was down to $5. It ended up closing up $5, a big $10 swing. So these markets can move very, very dramatically. I don't have any, major cycle stuff coming in here for another week or two, but that doesn't mean that the market can't turn, because you don't catch every turn. You catch some of them, but you don't catch all of them. But we do have major patterns here in the New York Stock Exchange Index with the ABCD, and also the Dow Jones, a perfect 61% retracement at 17,217. The high was 17,222, I believe. So as long as if we're strong today in the Dow or the New York Stock Exchange Index, this is it's going to go higher. The best thing to do is to wait a day and see if the market's going to turn and start downward. The odds say that it will, just what's happened over the last 8 times in the expiration of the S&P options pits. So that's all it is. It's a calculation of an expectation. And remember, expectations is where you get all your frustrations, is when an expectation is unfulfilled. Whether it's in the market or your children, whatever it happens to be, that's where you run into problems. So the only thing you can do is to protect yourself against this. And the only way you do that is to have a fail-safe system, like where you have a stop in the market, or you have a called uncle point where you say, look, I just can't take it anymore, and you just get out of the way and let the market do what it wants to do. But we've had one heck of a good rally from October the 8th, when we had those major Gartleys down there, and they were finishing Gartleys now to the upside, so we'll see what happens. So live every day in an attitude of gratitude, and may God bless.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.